Hey guys, welcome back to the channel. So in this video, I thought it might be a good exercise to take a look at the US equity markets in general. If we look at today, uh, it's the beginning of December. The S&P 500 is actually up 32%, which, is a huge return for the year. And over the past 3 years, on an annualized basis, it's up about 15% a year, which is, really strong returns for the US markets. So I thought it would be a good exercise to look at some of the valuations of the US equity markets in different sectors and across different market caps. This will just give us a good idea of which sort of sectors have been outperforming and underperforming the general market. And it might give us an opportunity to look at some strategic overweights that we might want to put in our portfolio for the coming year. Now, I think one thing that's been pretty clear is that we've been in a strong growth market in the US. So a lot of growth stocks have done really well. And there's been a lot of momentum. So, stocks that have done well have continued to do well. So I went ahead and pulled a chart. The way I'm going to break down sort of looking at the US equity markets is by looking at a few different groupings of ETFs. So again, we're not looking at individual stocks necessarily, but we're looking at different segments of the market, so different baskets of stocks. And so I'm going to look at sort of three different groupings. The first one is a grouping of ETFs that track different market caps and value and growth stocks. So I've divided, I'm using Vanguard ETFs, which I always like because they're low cost and they're oftentimes passively managed. So we'll look at mega cap, large cap, mid cap, small cap stocks, both by value and growth, and see how they have performed over the last year. And then I'm going to look at another way to split the market is just by looking at sectors. And so Vanguard has a whole grouping of different sector ETFs. And these range anywhere from, financials to utilities to consumer staples. But basically, Vanguard gives you passively managed sector ETFs that can help you overweight certain sectors that you think will do well in the short term, or if you want to bank on certain companies doing well. And lastly, I'm going to look at some of Vanguard's actively managed ETFs. Generally speaking, I would recommend going with a passively managed portfolio. So that's, ETFs that are indexed against a benchmark. So they're not actively managed by, portfolio managers. But, there is a time and a place for active management. The problem with active management is that it's really hard to select who is going to outperform the market. But generally speaking, Vanguard's actively managed ETFs are low enough cost that in some ways you're mitigating the risk of the downsides of active management. You're still honestly going to get a lot of exposure to the same stocks, but the reason I've placed some active management in here is because one of the active portfolios out of the 5 that they have has really outperformed the S&P 500. And so I think it's a good example to talk about when we're talking about how the market has done in the past year. Okay, so let's start by looking at a grouping of Vanguard ETFs by both market cap and by growth and value. So you can see here that I've ranked them by the trailing 1-year return. And I've shown which ETFs have outperformed the S&P 500. And so you can look at the top performer, which was the Vanguard Growth ETF. Now, the Vanguard Growth ETF does what it says. It invests in growth companies. It's generally going to be a larger cap fund, but it doesn't necessarily restrict itself to market cap. On top of that, you'll just see that growth ETFs have done well alongside mega cap and large cap stocks. So I think what's been clear over the last year is that really big companies have done really well. So NVIDIA's done really well. Even General Electric, Netflix has done really well. And we can see that of the ETFs that have underperformed, actually they, have still had strong performance. Even like value stocks have been less favorable in the last year, but even the Vanguard Value ETF has performed 25% in the last year, which is like an incredible return compared to general years in the market. So just strong returns overall. It's the question of whether you want to keep piling into growth stocks is whether we will think that like momentum will continue. And it does seem generally that like people expect momentum to continue with a lot of these stocks, but it's hard to say how long it will last. Becoming somewhat defensive might be a good idea too. We just don't know how the markets are going to perform. But, in a low interest environment, and if the Fed keeps dropping interest rates, people will tend to pile into the stock market. And people will be chasing, sort of these high growth stocks, trying to seek a higher return that they can no longer get just through bonds and keeping it in cash. If we're looking for sort of some opportunity in some of these markets, I've sort of looked at some of the PE ratios on some of these ETFs and looking at some of the sort of like mid cap and small cap companies, they've clearly underperformed compared to the S&P 500. So that just might mean that they have more room for growth in the coming year or 2 years. And again, value stocks are sort of like a good place to put your money if you're looking for strong fundamentals. This just means if the market turns down a bit, you'll have a little bit of protection. Okay, so moving on to the US sector ETFs, we can look at sort of which sectors have really outperformed in the last year. And so the ones that have outperformed the S&P 500 are financials, communications, information technology, and industrials. And this makes a lot of sense. I mean, we're talking about, financials generally tend to perform really well during times when there's less regulation. And I think a lot of the financials have done well since the presidential election, just anticipating that regulation will be lessened. As far as the communication and information technology sector, I think we've just seen a lot of these companies do really well over the last year. Information technology will include companies like Apple, NVIDIA, Microsoft, and Broadcom. And, these companies have just done so well, especially with the rise of AI. So much of their business revolves around artificial intelligence now, and that's a huge growth sector. The Vanguard Industrials ETF holds companies like General Electric, Caterpillar, Union Pacific. So yeah, these companies are obviously less tech focused, but are providing sort of more hardware and equipment. Now, if we're looking at sectors that maybe have potential for growth over the next couple of years, like we can look down and see that energy, healthcare, and real estate have really underperformed the market. And in this case, we can actually see that like the returns have been a lot lower than the general U.S. equity markets, even when we're talking about market cap and growth versus value. Energy has, only gone up about 12% over the last year compared to the 32% that the S&P 500 has been up. And, so some of these offer an opportunity maybe to sort of get in at lower valuations. These ETFs are probably trading at sort of more of a discount because they haven't done as well over the last year. Real estate especially, I think if we look at the 3-year return is actually is negative. So, there's probably room for growth here. At the moment, there is still strong momentum. So, I don't necessarily know that pulling back on any of these sort of like strong performing sectors is necessarily like the right call at the moment. And another thing sort of to look at is also the beta to the market. So you can see that some of these ETFs have a pretty low beta to the overall market. And that just means that when the S&P 500 or the US equity market moves up or down, these stocks will tend to move less with that movement. And so it's not a bad idea to have some lower beta stocks in your portfolio. This will just help you weather any sort of downturns. Obviously, like a beta above 1, it'll sort of exacerbate how well or how poorly the market is doing. So that's why, some of these stocks with high betas have done really well because they're moving with the market, but they're moving even more than the market. So, if we're thinking that, momentum will continue, it's not a bad idea to have a strong, a high beta. But if we think that the market will pull back, it might be a good idea to move into lower beta ETFs. Finally, let's look at some of these actively managed ETFs that Vanguard has. Again, I like them because they're fairly low cost compared to other actively managed accounts. And you're going to get exposure to many of the stocks that are in the passively managed index funds. So if we look at the Vanguard US Momentum Factor ETF, I think it's a good example just to show where the market has been over the last year or two. You can see that over the last year, it's up 44%, which, is much higher than 32% of the S&P 500. And what's interesting to note is that, the Momentum Factor ETF basically just invests in stocks based on how strongly they're doing in the short term. So, they look at performance over the last year, over the last 3 months, to decide how much to weight these stocks. And we can see that it heavily invests in these really explosive stocks that have been happening lately. So like Palantir, KKR, Nvidia, these stocks have all done really, really well over the last year. In fact, there's a stock sort of in the top 10 holdings called AppLovin Corp, which over the last year is up over 800%. So these are incredible returns. And that happens in sort of like a momentum market. So yeah, the question is whether momentum will continue. And, it does seem like there's still room for growth. The question is when that comes to an end. So again, I think looking at this chart, we can see that there are opportunities for sort of undervalued stocks. But, the question becomes, when do you pull the trigger? When do you sort of decide to start putting more money into those more defensive stocks? And it's really hard to predict when the market will turn. So, it just offers us a chance to take a look and take stock at the US equity markets for the last year, and just to see what stocks have outperformed and what stocks have been underperforming. And it gives us a chance to kind of like look at where we might have some opportunity. I'm going to go more into depth on actively managed ETFs, but I wanted to raise the US Momentum Factor ETF just to characterize the markets for the last year. But I'll have another video going over each of the 5 actively managed Vanguard ETFs. Hope you found this video helpful, and let me know if you have any thoughts on where the market might go in the next year or two.